Hey folks, David Frost, MyStrategicForecast.com. Welcome for another episode of Common Sense Technical Analysis. Today is Tuesday, June 24th, 2014. Here's a chart of the SPY, which mirror images the S&P 500, and we finally had a down day of some kind of substance. The question is this the big turn or is this a small turn? And basically, my take is this is a small turn. If you remember from last week, late last week, I began discussing the fact that Saturday was the summer solstice. And normally, or usually, which in our business is high probability, that it marks a market turn. And lo and behold, yesterday we had a pause day, which was the first day following the summer solstice, but today we had the turn. And, here's what happens from this point forward for the next week or two. We may go down for, let's say, 5 to 7 days. That's probably my worst case scenario right now. That brings us into mid next week, okay? If we go into mid next week and you begin to come into the 4th of July holiday, I think the volume dries up and the market would have a difficult time going down into the 4th of July weekend. It normally will float around a little bit higher into the 4th of July weekend. If you go back in time, that's what you'll see on those kind of holiday weekends, those long weekends. It usually floats into them with light volume, and I would expect the same here. So I think this is, a week or so of some down movement. If we're going to get any follow through tomorrow, that's what I'm looking for. But it was somewhat expected. I told you a turn was coming. We don't know how far down, although I would say, and I have the cursor right here, in my book, 190, maybe slightly below that, maybe 189.5 is about my downside on this move if we're going to go down that far. So basically what I'm looking for, worst case scenario right now, is a pierce of the 50-day or 50-period moving average, which is right here at 190.5, and that'll creep up day by day, and I wouldn't be surprised to come down to this area, 189, 190. In that neighborhood is a good downside target. It's enough to shake out the weak hands, but yet it still maintains a bull market. So that's my take on the S&P. We'll see where the next day or so takes us, but I think we're going to see some downward pressure from this point forward for the next several days. Okay, so moving on. You know what? I don't want to move off the stock market just yet. I want to take a look at the IWM, because if you look at the IWM had a pretty decent down day today, a little bit worse than the S&P, and from the high at almost 119, okay, the high today was 118.91, and your low today was 116.65. Okay, so that's a pretty good move on the IWM. And remember, I said that I didn't think we were going to get through this area here. And then what happened was we continued up and we consolidated a little bit, and then we made another move higher. But guess what? What stopped us this time? The next pivot high. So this is the way you manage from day to day. You take a look at highs and lows, you take a look at patterns, and you take a look at time, and you make a common sense technical analysis out of it. So what happened? I said that we're going to have a difficult time getting through this pivot high at 115. Okay? We got through 115, and then I said, take another look at this pivot high. Okay? And where did we stop? At this pivot high at 118.5 for the most part. So, what's the next? If we went up farther, I would tell you the next pivot high up here, which is a big double top. That would be huge if it got through that. I don't think we will get through that, but it's possible. And so you just take a look at one step at a time. You don't trade a market or don't put on a trade based on what you think should happen. You let the market tell you what you should do. The market is the one talking. Remember, the market are people trading against each other. So the market is nothing other than a bucket of people trading on a bucket of emotions up and down. So it's basically when you see these pivot highs, this huge red bar down means that there was a ton of sellers in here, and everybody that bought in this area really got hammered on the way down. So what happens on the way back up? They're the ones that are saying, let me out even. And that's the psychology of the market. So each time you see one of these pivot highs, you know that somebody's happy to get out even, and that's going to be a form of resistance. And the other point is that if I know it's a form of resistance, there's a whole lot of other traders out there that know it's a form of resistance, and they're doing the same thing. Okay, they're putting on trades based on the fact that they know it's a resistance point. I'm not the only one out there that knows these numbers and these pivot points and these highs and lows. I mean, once you learn how to do it, it's almost like waking up in the morning and getting a cup of coffee. You just look at a chart and you see what the highest probability move is based on what's happening today and the pattern and what happened in the past. So hopefully you're starting to understand that from these videos, and that's basically the way I read them. All right. So let's move on, and let's take a look at the gold market. So we're going to take a look at the GLD. All right. There we go. So we had the huge up move last week, okay? And now we're having some, sideways pause day pattern type of thing. The market's basically trying to decide if a higher move is coming or we're going to consolidate further and pull back. Now, here's my take. So what I see happening here is I think this move was significant. This move to me last week was the canary in the coal mine, if you will, of the oil market. The gold market. So the canary in the gold mine, we'll call it. What happened was we had a big up move, and now I think we will consolidate down. I think we'll go sideways. I think we'll pull back some. We'll chop around here for, let's say, a couple of 3 weeks or so. And if that's the case, I'm going to look to put on a nice big long trade, because if we stay above this 200 period moving average inside this big bar here, I think this market is poised to shoot higher. And if you think about it, I'm going to talk about it in a little while again, but real briefly, that I think the market's going to turn in a much bigger way in July, the stock market. Now I'm telling you the gold market is going to turn in July on the upside. Okay. Now I'm going to put together oil in this conversation when we get to the oil chart, and we'll start to see what the possibilities are of what may be playing out here. In fact, let's just go ahead and do that. Let's move right over to the USO and take a look at the oil market. And here, you had basically another pause day in the oil market. But if you look at this, you're seeing sideways consolidation pattern. And, I always love to go over to the weekly chart because it's so crystal clear to me on the oil. Is this high is just basically taken out almost. We're at this high now, and I think that there's just a little more upside. I wouldn't be surprised to see the USO punch through 40, and I wouldn't be surprised to see the price of crude go to 110 or in that neighborhood. And if that's the case, and that happens coinciding with what I believe to be the turn date coming in the stock market, which I think may coincide not briefly, but within days of a turn in the gold market. And maybe that's another turn in the oil market at the same time. So we may get the trifecta. We may get the market turning down, gold turning up, and in my book, I think oil turns down at that time. And what that to me means is, on one hand, you would have a lot of deflationary talk. You would have a lot of slowing in the economy talk. But at the same time, there's got to be something else going on if gold's going to go higher, which means it's going to be deemed the safety trade, or the dollar could potentially be going down, and we're running to gold to protect against a deflating dollar. I don't know if that's the case with the dollar, but if gold's going up, they're going to tell you it's the fear trade, and that's fine. We don't really care what it is. We care what other people think it is, because what other people think it is causes them to buy or sell markets. And we're reading the charts, and the charts are telling us what the other people are doing, and therefore we're going to take action on what the charts tell us. So it's a little bit more drawn out than just knowing what Joe Smith is doing, but what the charts are telling us what Joe Smith is doing. So that's the way we're going to read it, and that's kind of what I see shaping up here in the next month is kind of the scenario that I'm discussing now. Market down, oil down, gold up, fear trade, deflation, slowing of economy, and it could be mixed in with some trouble in the Middle East. Maybe that's the fear part of it, the oil, the gold part of it. We'll see. Whatever the media says it is, we don't really care. We read the charts, and the charts tell us what to do. Let's look at interest rates. I know this video is a little longer than normal, but I'm going to try and wrap it up here shortly. So interest rates, so we're still on the weekly chart here, and you know what? This weekly chart to me is very, very bullish. You're riding this 200 period moving average for a long, long time. Okay, you're riding it for a year. And since we're riding it for a year from basically June of 2013, this thing is poised to go higher, setting up to go higher. This is the 10-year. We're going to chop around for a while longer. Look at the monthly chart, okay? If you look at the monthly chart, it's even more obvious to me that this thing, now we're riding the 50-period moving average. The 20 is sloping up. You have an up move. You have bullish consolidation. I think you bottomed in here. And let me show you something else, which you have to understand that most every asset class at some point in time reverts back to the mean. So what do I mean by that? Well, let's go back in time. And I think this chart goes back to the early 90s. Yeah, we're at this chart only goes back to 1994. But nevertheless, let's see if we can blow it up a little bit here, just so you can see it better. Well, apparently not. One more try. Okay, so what you see here is interest rates here at 8%. Okay, 8% and a stair step all the way down. Okay, this has really gone all the way down. It's really been 30 years. That's basically what the chart doesn't go back as far as I would like it to, but you could see it go. If you saw it, it would go back 30 years. Is basically the downtrend in rates and rally or bullish market in bonds 30 years long. So here's what's going on. So I think this is bullish consolidation. I see it riding down the 50-period moving average, 20 sloping up, and remember, revert back to the mean, okay? You have a high over here of 8%. If you went back farther into the 70s, this would be 16, 17%, 15%. Okay, so how about a third of the amount, which is a Fibonacci retracement from 17% from 30 years ago down to 1.4, okay, or 1 point, what was the low here? 1.39, all right? So what's a third of that? Basically, a third of that is let's call it 4.5 to 5% is just a third retracement. All right. So what's that? That's at least a double from here. Where is that? That's up here. Okay. This is where it's going, folks. It's not going to go there overnight. And don't forget, this is a monthly chart. This could take another 2-3 years or more to play out, but we're certainly going back to 5% at a minimum. Okay, and this would be 50% retracement from 1994 from this 8%. All right, so we'd go to 4% here. So basically, you have to understand that I'm in this TBT trade, and I'm not going to hold this particular TBT trade for 2 or 3 years, but I think this is the beginning. I think you're going to see fits and starts. You're going to chop around. Okay, you're going to be back to 3%. You're going to be back down. But all in all, we're going back to 5% on the 10-year note. There's no question about it. It's just a matter of when. It's beginning to play out now. Okay, so you have to be aware of that. Higher interest rates, strangle the economy, lower stock market, deflationary, poor earnings. Okay, it's a self-fulfilling prophecy. It just is a snowball effect. Oil down because the economy's slowing. We use less oil. We use less product. We're buying less product. So price of oil goes down. Gold could be a separate animal up on the fear trade, remember. So all these things, I can see them beginning to play out. And I think a year from now, 6 or 8 and 10 months from now, we'll look back and say, yeah, that was the beginning of all those things beginning to play out. We'll see what happens, folks. Common sense technical analysis. I'm David Frost. Thanks for tuning in. We'll see you on the next episode.